and happy you all returned to learn more about financial literacy. And today we will focus on mortgages. Getting a mortgage might just be one of the biggest financial decisions you make in your entire life. No pressure. And besides, I'm here to help you learn something new and maybe feel a little more confident going into it. If you've ever played the game Monopoly, you probably learned that you can mortgage your properties. You know, you flip your property card over and the Monopoly bank gives the player some Monopoly money. In turn, you have to pay the Monopoly bank back before you can start earning money on your property again. Such as it is in this game of Monopoly, it is in life, sort of. First, the concept of a mortgage only comes into play when you're dealing with real estate. Did you know that you can't mortgage a car, or a bicycle, or a cat? Sorry, Mr. Fuzzles. You can only mortgage real estate. Sure, you can take out a loan to buy a car, but it's technically not a mortgage. Second, when you take out a mortgage, as the expression goes, you're borrowing money against the value of your real estate. And get this, it's not even the mortgage document that makes the loan what it is. In reality, it's a contractual agreement called a promissory note that really contains the details about the loan and that binds a borrower to repaying the loan. You see, a mortgage document is really just an extra agreement that puts the public on notice that some lender out there has granted some borrower out there a loan secured by a piece of real estate. But the specifics of a loan and the requirement to repay it is primarily spelled out in the promissory note. Still, I suppose it's a lot easier to say you mortgaged a property than it is to say you promissory noted your house. And now, ladies and gentlemen, the big question. Where does one go to find a mortgage, and why would they want a mortgage in the first place? A mortgage lender could take that form from a bank, credit union, or a number of other financial companies. A mortgage loan allows you to borrow money. So, as we spoke about over the past couple of months, interest rates and annual percentage rate come into play here. And you'll most likely have to pay the lender back with interest to be able to purchase your dream home or leverage the equity in your existing home. And you might be thinking, why would I want a mortgage? Or why would I want to pay a lender money monthly with interest? Well, it's pretty simple. Most of the time, people don't have hundreds of thousands of dollars in their pocket to buy their home outright. Being able to build equity and own a home is sometimes a better option than renting from people. And sometimes people want to take advantage of the equity in their home, such as make home improvements or pay for college, and they can use their home as collateral to take out a loan. These are situations where a mortgage come into play. So let's say you now have that dream home you've been looking for, and your mortgage statement comes in. What are you looking at now? Well, typically on mortgage payments, you're paying the principal balance, interest amount. Sometimes you have property taxes included, and sometimes you also include your insurance payments as well. If things like taxes and insurance are being included in your monthly payment, this means they're being held in escrow by the lender, who is in turn paying them. Escrowing is helpful to make sure all items are included in one mortgage payment, and it makes the lender feel better about the loan because they know these important expenses are being paid. Be sure to speak with your lender about escrowing. They might even require it. If you obtain a mortgage with putting a little less money down, you may have to pay private mortgage insurance, also known as PMI. Mortgage insurance is something that is typically required if the amount of your mortgage loan is greater than 80% of the collateral's value. So what does that mean? That means lenders have a variety of mortgage products available, and some of these products may require mortgage insurance. Mortgage insurance protects the lender and gives people an opportunity to still buy a home even if they don't have a flush savings account. If you're looking into one of these high loan-to-value products, make sure you work with your lender to fully understand how mortgage insurance will be paid, when it can be terminated, and how termination can be requested. Last piece of this mortgage puzzle would be interest rate and annual percentage rate. Yes, we did just go over this, but quick refresher. Be sure to look at the annual percentage rate and shop around. That might make or break the deal for you. Look to make sure whether the loan has a fixed rate or an adjustable rate, and again, look at the annual percentage rate as an easy way to compare how much the loan is going to cost you. Thanks for looking into mortgages with us this month. So much information, and the perfect people to talk to about this would be mortgage loan originators. They know the ins and outs. Take a look and investigate before you make any decisions. See you next time for another fun Finance Friday.